Hey everybody, it's Dow Jones Dave with our weekly Dow Jones Industrials Composite Dividend and Earnings Event Report. I'm not an investment professional, just some dude that has ideas about the stock market. You can lose all of your money trading any stock, regardless of what anybody, including me, says. There. So now you're disclaimed. Let's get to the report. First of all, the only component that reported this week was the Walt Disney. And first we'll go to the technicals, then we'll go to the numbers. I know some of you's brains freeze over when you see numbers, and but they shouldn't because the whole stock market is numbers. So I'm gonna help you with the numbers. That's one of the things this channel is all about. And the numbers down here are a stock report that I want to see somebody do, but nobody does because it's a lot of work. That's why. So I have the complete composite set up just like this. I'm updating it. I have 10 stocks to go, and I'm not going to get done this week. So there's a specific reason I'm doing my own composite database, and I will get to that in another video. Now let's get to Walt Disney. Now, Disney has a lot of critics right now for various reasons, and I'm one of them for a numeric reason. However, technically it looks pretty good. It's broken this trend. It's coming back to retest it, and then if the retest rejects it, it's probably going to go. There's a big gap here, which I actually have here. There's a big gap here, you see. So you run into resistance right around here at 96 probably, but once you break the trend, you've got some horizontal resistance here, but this resistance becomes weaker and less effective to hold the stock price back once it's broken a trend, retested, and starts to move. And like this is a monster gap, so this surely needs to be filled. Will it be filled right now? I don't know, but I am expecting a rally into late August. Even though I probably stupidly took a October put on the S&P, I'm probably going to sell out of that. That was probably premature. I've been really conflicted lately because I know seasonality puts the market topping out last half of August, usually later in August, and like the last week, but the markets has been throwing off a lot of short signals. It's not anymore because the indexes, at least the S&P and the Dow, both look like this. They're both in this, just right here, just about. If you look at the charts, you'll see it. Now, is there a big gap on the indexes? I don't know. I don't think so. But there may be a lot of gaps on the individual components. Don't know. Once again, I don't know. I'm just doing the numbers on those. So that's the technical analysis. It looks pretty good. If this trend line right here were to fail, then I'd get really concerned about this bottom, and if it breaks that bottom, then I'd surely be a short. Even though I don't really like shorting that kind of stuff, I like this kind of stuff, breakouts. Which, if you invert this, turn it upside down, it becomes a short. Because these principles apply the same. On an uptrend, you draw the line on the bottom. So like here, you would draw it from the bottom. Watch this. Trend break. Retest. Down you go. Trend break. Retest. So that's what we're looking at technically. Now, let's get to the numbers. And I'm going to explain to you all of this stuff. First of all, the red. The red means one of two things. If it's got a minus sign in front of it, it's a negative number. If it doesn't have a minus sign in front of it, it's a positive number that's negative in relation to the previous number. So here, let's start with 52-week EPS. It's earnings per share net. The last 4 quarters adds up to $1.23. The last 4 quarters ending the previous quarter add up to 182. So your net EPS is down significantly. All right. So we put a red on the current EPS. Year-over-year operating earnings growth. I'll explain what operating earnings growth is in a minute, really simply, when I get to it. Quarter year-over-year operating growth, and the O means it's derived from operating earnings and not the net earnings. Really important. Is minus 100%, so both operating and net earnings tanked, is cratered out. Those are both kind of negative, right? So we put red numbers on it. And it's just a way to assist you. I don't need the red numbers because for some reason I look at a stream of numbers and I see it all. But I know people have a hard time with numbers, so my reports put negative stuff, downward trending numbers in red. So what else is red? Our 52-week operating earnings, which is the corresponding earnings for this period, but this is operating earnings, doesn't include extraordinary gains or losses or one-time charges. So did they take a charge? 52-week earnings is 220. 52-week operating earnings is 220. Net earnings is 123. So yeah, there was a extraordinary charge, one-time charge. They call them extraordinary gains or losses, and those are not included in operating earnings. And you can see why. It's charges or gains that aren't generated by operations, and we're interested in operations as investors. And yeah, this loss was real, but especially the quarter over quarter, but it may be only a one-time loss and not affect earnings next year. That's why you take it out when you're looking at growth rates and earning streams. So year-over-year growth is bad. 52-week net EPS is bad. 52-week operating earnings are lower than the last fiscal year, which is bad. It can be good if you're coming out of it, but is Disney coming out of it? Now this year we've got green, so consensus earnings estimates, which are operating, which is why you need to derive the operating earnings here, and you can't base your growth rate on this number, which the PEs on all the stocks you're looking at when you get a random quote on the internet are based on this number, not this number. So you're going to think your growth rate is twice what it actually is if you try to derive growth rates, look at estimates, and then derive the growth rates from net EPS. You see what I mean? Because net EPS it has a charge that isn't going to be repeated, so the earnings are actually higher, so the growth rate calculated off this current EPS would be artificially high, and you probably, you're comparing apples and oranges, and you don't do that. So this year estimates were brought up by analysts, not me, analysts. This is consensus estimates. These 3 numbers aren't anything to do with me. That's what the professionals think. So this year estimates rose. That's why it's green. So estimates, red means estimates were brought down. Green means estimates were brought up. So we don't like that they were brought down. And to tell you the truth, this I don't think is achievable because the fiscal year ends in September. That means this is Disney's 4th quarter, and they have to improve their earnings by $1.53 in 1 quarter. They don't have to make $1.53. They have to make $1.53 more than they made last quarter to make these estimates. And I don't think there's a snowball in hell's chance of that, to tell you the truth. especially not with this. So at the very minimum, you need to see the quarterly year-over-year growth for operating earnings go green, positive number growth. And until I saw that, I wouldn't be a long-term investor in Disney. It will underperform, I'm sure, over time, other stocks in the Dow. And that's just my opinion. If you're a Walt Disney fan, don't get mad at me. I'm just telling you what I see. Now, over here, we see the estimated growth for these operating earnings, and that's measured from the 52-week earnings on out. This is like 2.25 years, and this growth rate is derived by dividing the growth rate from the year after earnings to the 52-week earnings and dividing it by 2.25, which is 2 years and 1 quarter, which is how much time we're measuring from the 52-week earnings. So this is a prorated growth rate, and it's estimated. So I'm not saying they're going to make 74.24% growth rate. That's what the analysts say. And estimates are always rosy, so it's not going to be 74.24%. I'll guarantee you it won't be. If it is, I'll mail you 50 dirty socks. How's that? And you can wash them and you'll have like 50 socks. So the PE, if this wasn't red, if this wasn't so much higher than this and only 1 quarter this quarter to achieve it, and if a lot of things, this would be a growth PE of 1.9, which means you could theoretically presume a 90% profit in a year. But there's a whole heck of a lot of ifs here, and although I'm not negative on the stock because of the technicals, this stuff doesn't have any real effect on short-term technicals, rallies and declines and stuff like that. This is long-term. This is looking long-term. Do you want to buy Disney long-term right now? Personally, I wouldn't. If I were your advisor, I would say, no, wait for it. I would also say if you want to make a short-term buy and sell in a couple of weeks, you might have a good trade. I actually believe that Disney's going to come down, test and rally. That's what I think. So, but I'm just some dude that calls himself Dow Jones Dave on the internet, and so take it for what it is. This is Dow Jones Dave with my weekly component event report, and I hope you all have a nice day.